Welcome all to the third session, and this session is going to be about Fed rate hike and how that is going to impact you. The recent Fed rate hike. On September 21, the Federal Open Market Committee announced another huge rate hike, raising the federal funds rate by 75 basis points to a range of 3% to 3.25%. The next Fed rate meeting is on November 1 and 2, first and the second, and we can expect a rate increase of 0.5% to 0.75% depending upon the economic data in the next 2 months and also the inflation data, which is a key based on which they are going to adjust this Fed fund rate on November. The biggest impact will be your credit card interest, which will become more expensive. If you are a person who carries a balance in your credit card, and this rate increase will impact you in a big way. Normally, credit cards have a variable APR, which is a combination of a prime rate plus a percentage on top of that to cover the operating cost of the credit card issuer. For example, if your APR is 18% on your credit card, that is on your balances that you carry forward, after the Fed rate hike, it will be 18.75 because in the recent Fed rate hike, it was increased by 0.75 percentage. The next major impact is your mortgage loans. They will become costlier also. If you're planning to borrow to buy a home or use your current home equity, you will likely face a bigger monthly payment going forward. The 30-year fixed mortgage that was around 3% a year back has reached a 14-year high of 6.02% last week, and this will increase further with this rate hike. Short-term loans like home loans with floating rates like adjustable rate mortgages called ARMs and home equity lines of credit, HELOCs, are tied to the Fed funds rate. And these rates for ARM and HELOC also will go up when the Fed funds rate goes up. The adjustable rate mortgages are normally like a 3-year ARM, 5-year ARM. Basically, they're fixed for the first 3 years or first 5 years, depending on the type of ARM. And after that fixed period, it will increase with the Fed funds rate. So if you have taken an ARM, say 5 years back, and now the 5 years completed, and initial rate was say 2.5%, now you could see it going up to a much higher rate after that 5-year period. This chart will give a clear idea of how this 30-year mortgage rate has increased in the last 9 months. If you see last year around this time, the 30-year mortgage has been around 3%, and in fact it was below 3% around July, August, September time frame. And after that, in December 30th, it was 3.11%. And now you see in the last 9 months, it's almost more than double, going beyond 6% here. And anybody buying a home around last December would have just paid around 3% mortgage rate for the 30-year mortgage. But now you will be paying more than 6%. So you will be paying almost double the interest cost in the last 9 months. And this is how this increase in Fed funds rate will be impacting the common man. One thing that benefits the investors is the savings and CD rates goes up when the Fed funds rate increase. This will go up slowly as banks increase the interest rate they pay on deposit accounts. That includes your savings account, money market accounts, and the certificate of deposits. And if you see the chart here, that will give an idea or indication of how these rates increase very slowly compared to the Fed funds rate. The Fed funds rate increased by around 3% in the last 1 year's time frame, but this you see that it has increased by 0.5 percent only. And this is more like an average rate for the 1-year CD across all the banks. Ideally, you can get a better rate if you search online, and you can get some very good CD rates. I've given some examples, like Capital One gives you 2.75% for a 1-year CD, and Discover gives you 2.70% for a 1-year CD. The next major impact is on the student loans. Students who take out new private student loans should be ready to pay more as Fed rates increase. The current interest range for federal loans varies between 5 and 7.5%. And unfortunately, this will keep increasing with the Fed funds rate increase. If you are an investor in cryptocurrencies, you will also get impacted with the Fed funds rate increase. Bitcoin has dropped from $65,466 to the current $18,764 in the last 1 year. With higher rates, people move the money to safe assets like treasuries and avoid risky assets like technology stocks and cryptocurrencies. And if you see the graph here, the chart here of cryptocurrency Bitcoin, you see in the last 1 year, it's been on a continuous downtrend with every Fed funds rate hike. The next major impact is on the stock market correction. Stock markets have been correcting a lot in the current financial year, from a high of 36,952 to the current 29,529, which is a loss of almost 20.08%. Any correction more than 20% leads to a bear market. So we are technically in a bear market, and most probably we should reach a bottom in the next 6 months in the stock market. And if you see this chart pattern here, so this is where we reached a high of 36,952, and with every Fed funds rate increase, you see the market has been going continuously on a downward path, and currently it is around 29,529. These rate hikes could lead to a potential recession. How it will impact? It could slower consumer and business spending. The lower business spending will impact job creation and growth. And there is the potential for a mild recession in the fourth and the first quarter of 2023. And we have the possibility of a soft landing if inflation can cool down quickly. So be careful of where you put your money during this time frame. And that is where this learning series of videos will guide you to make the right decision on your investments. One best option to protect yourself is CDCI savings bonds from the Treasury. The key features of the CDCI bonds are as follows. This CDCI bond offers a stunning interest rate of around 9.62%. What are the criteria? You need to be a US citizen or resident. And in a calendar year, you can acquire up to $10,000 in electronic I-bonds in Treasury Direct and up to $5,000 in paper I-bonds using your federal income tax refund. And when can you cash the bonds? You can cash it after they're 12 months old. If you cash an I-bond before it is 5 years old, you will lose the last 3 months of interest, which is still not bad compared to the high interest rate that you get out of that. You might lose 3 months of interest. And I-bonds earns interest for 30 years if you don't cash the bonds before they mature. So if you can keep this for the long term. And for more details about this, please visit this link from the Treasury Direct, and you can get more details about this SeriesI bonds and decide whether it is suitable for your investment. The one limitation is you can go up to a maximum of 10,000 through electronically. you can invest, and 5,000 through paper bonds. So that's the limitation. You cannot put more money into this than what is mentioned here. Disclaimer. These videos are strictly for educational purpose and do not provide any advice, tips on investment, or recommend buying and selling of any stocks, options, ETFs, mutual funds, or bonds. We neither take guarantee of profit nor stand responsible for any losses of any recipient. The recipient of this material should get their own professional advice before doing anything based on this information. The recipient is advised to read the above information carefully before any investment and taking any decision on that. Other videos that are coming up. How to buy your stocks using a brokerage account. This is very useful for beginners and first-time investors. Traditional IRA and Roth IRA, and how do you invest in them for the people who are interested in the retirement investing. Simple index fund investment options. Stocks, mutual funds, ETFs, and bonds, and how to invest in them. Dividend stocks and how to choose the dividend stocks. What are options? The basics of call option, put option, and covered calls. Fundamental analysis of stocks. Technical analysis of stocks using basic chart patterns. Candlesticks like Doji and how to use them in your investment. How to measure your portfolio performance. So many more video sessions coming up to teach you a lot on the investing related topics. If you like today's session, please click on the subscribe button and click on the thumbs up button to show that you like this video. Thank you for watching this video and see you soon in the next video.